Welcome to The Explainer. So, if you want a really clear eyed look at the absolute foundation of the modern economy, you are in exactly the right place. Today, we're diving into literally the master lever of global finance: interest rates. We're going to break down how this one single metric dictates everything from your personal mortgage all the way up to global inflation. By the end of this, you'll have a super solid, confident understanding of exactly how money moves. Let's get into it. So, why do interest rates actually matter? Well, imagine this incredibly precise dial. When that dial shifts by even a tiny fraction of 1%, boom, it sends these massive waves crashing through the entire financial ecosystem. Seriously, it simultaneously affects your personal savings account, the monthly payment on your car loan or mortgage, and the wider global economy, all at the exact same time. It dictates how businesses operate and how everyday people like us spend. Honestly, understanding this single metric is like holding the master key to global finance. Here's our roadmap for today. 1. The core definition. 2. The ripple effect of challenge. 3. Everyday impact. 4. Central banks and inflation. And 5. 5 essential takeaways. Moving right along to section 1, the core definition. We're going to look at understanding the price of money. Think of this as the absolute foundational rule of the financial ecosystem. An interest rate is generally just the cost of borrowing money or the potential return paid on certain savings and deposit products, right? It's a fundamental two-way street. If you borrow money, you pay for the privilege. If you save money, you get compensated for it. But, and this is absolutely crucial, actual rates always depend on the specific financial product and the provider you're dealing with. It's a highly dynamic metric that gets customized by the institution. Let's ground this with a concrete example. Say you put $1,000 into a savings account at a simplified 5% annual interest rate. Well, that yields $50 over 1 year. That's the foundational math at play here, putting your money to work for you. Now, obviously, real-world products vary wildly with compounding schedules and fees, but the core mechanic, it remains exactly the same. Okay, section 2, the ripple effect of change. Let's see what happens when the dial moves. A shifting economy forces these dual outcomes. When rates are rising, borrowing costs can go up, making loans way more expensive. But conversely, your savings yields can increase, meaning depositors might actually see higher returns. On the flip side, though, when rates are falling, borrowing costs can drop, which really encourages consumers and businesses to take out loans and spend. But those saving rates may decrease. You see, every single shift creates a completely different environment for savers versus borrowers. Which brings us to section 3, everyday impact. Let's talk about mortgages and credit cards. This dichotomy we just talked about brilliantly illustrates one of the biggest decisions any homeowner has to make: fixed versus variable rates. Look, if you have a fixed rate mortgage, your interest rate is locked in. That means a sudden rise in global rates won't immediately change your monthly payment. Phew, right? But if you have a variable or floating rate mortgage, your borrowing costs literally change as broader rates move. Understanding this mechanism is an absolute must for anyone trying to navigate the housing market. And then, of course, we have credit cards. Carrying a balance from month to month subjects you to the card's specific interest terms. So when that broader economic dial gets turned up, the cost to just hold on to that debt becomes significantly more expensive. And I mean, really quickly. It hits the nail on the head as to exactly why navigating your personal balance sheet requires, well, actually knowing the current rate environment. Moving to section 4, central banks and inflation. Time to zoom out to the macro economy. So you might be wondering, who actually turns that macroeconomic dial? Well, in the USA, it's the Federal Reserve, and in the UK, it's the Bank of England. Now, their institutional frameworks are definitely different, but their core mission is shared. Both conduct monetary policy to influence economic demand and inflation. They're basically the architects of the rate environment, pulling these massive economic levers to try and keep their respective economies stable. Now, there is a massive misconception we really need to clear up here. Rate changes are absolutely not an instant magic fix. Not at all. Think about it. On day one, a central bank announces a change. Okay, but then it takes 1 to 6 months for everyday borrowing and spending behaviors to actually adjust. It takes 6 to 12 months for broad economic conditions to visibly shift. And it can take up to 2 full years before inflation is actually meaningfully influenced. Monetary policy is essentially like steering a giant cargo ship. You turn the wheel today, but the massive vessel takes time to actually alter its course. The whole chain reaction looks something like this. Step 1, the baseline interest rate changes. Because of that, step 2 happens. The actual cost of borrowing for both everyday households and megacorporations adjusts. That shift leads right into step 3, altering how those entities choose to spend and invest their capital. And finally, step 4, overall economic activity reacts. It's just a profound systemic ripple effect stemming from one single policy lever. And that brings us to Section 5 essential takeaways. Let's summarize our findings. Let's run through the absolute pillars of what we've mapped out today. First, interest is simply the cost to borrow money or the return you get on deposits. Simple as that. Second, higher rates can increase your borrowing costs, making those loans pricier. Third, conversely, lower rates can actually reduce some of those borrowing costs. Fourth, because of all these changing costs, rates directly dictate the saving and spending decisions of both everyday folks and massive businesses. And fifth, central banks actively use these rates to influence overall economic conditions and manage inflation. As we wrap up this explainer, I really want to leave you with a final vital thought. Understanding interest rates is totally foundational. They are the absolute key to decoding the global economy. So now that you know how these hidden gears turn, how will this knowledge shape your view of the broader economy today? Next time you see a headline about central banks, I hope you can actually see the bigger picture. Thanks so much for joining me, and keep learning.